way US stocks are pumping right now might just be to engineer some downside room for the upcoming earnings season.
This narrative is going around the internet. Do you buy it? Last night, the Nasdaq 13-day daily winning streak finally snapped. The S&P 500 also printed a small red candle. And plus, the US-Iran negotiation results drop tomorrow. Regardless of the outcome, market makers will likely use it as an excuse to dump the market and harvest some liquidity. Why am I making this macro call? Because one of the biggest engines behind this rally, the systematic CTA buying, is running out of gas. Over the past week, CTAs bought 33 billion worth of S&P 500 contracts, and now they only have about 23 billion in potential buying power left. Goldman Sachs explicitly warned that peak buying velocity from this group is already behind us. Naturally, the index is going to struggle to maintain its one-way parabolic trend. On top of that, the S&P 500's RSI has hit 72.3, putting it in severely overbought territory. This is a textbook warning signal. Historical data shows after hitting this level of overbought conditions, the market has a high probability of a pullback or sideways drop, besides a massive wave of corporate earnings drops over the next few days. And this entire bounce has been heavily carried by the Magnificent Seven, which accounted for 60% of the index gains. Earnings expectations for these mega caps have long been fully pricing. So no matter how beautiful the data is or how strong the profits are, we are highly likely to see a classic buy the rumor, sell the news event. But if a pullback does trigger, there's no need to panic. Why? If the CTA buying power is fading, hedge funds are stepping up to the plate. According to the Goldman Sachs Prime brokerage data, hedge funds started accumulating the Max 7 in April, pushing their net exposure up from the YTD low of 15 to 80%. And meanwhile, the global TMT, tech, media, telecom sector saw record net buying last week. This is pure proactive long accumulation. It shows there is a genuine underlying bid demand, not just short coverage. This tells us that from a macro perspective, the market has rotated out of macro risk-off and back into the AI-driven growth narrative. Smart money is using the pullback as an entry window to continue loading up on core assets. So this pullback is just a healthy rotation of hands, not a trend reversal. So what's the read on gold and oil? First, regardless of whether tomorrow's negotiation outcome is good or bad, gold is highly likely to take a hit tomorrow. If US equities dump, gold easily gets dragged down as collateral damage. If talks break down and geopolitical tensions flare up again, gold will still get sold off for liquidity. But short-term volatility doesn't change the long-term macro thesis. Now for crude oil. Brent crude is pushing right back up against $96. The market is already front-running the premium. 3 US cavalry strike groups are about to converge in the Middle East, forming a complete encirclement around Iran. I highly doubt Iran is going to fold easily, and under this extreme military pressure, any slight misfire could detonate a massive supply disruption. The bullish macro logic for oil remains absolutely rock solid. As always, this is just my personal trading analysis, not financial advice. And shout out to EBC Financial Group for sponsoring this content.